Welcome to the Heritage Wealth Planning YouTube channel. I got 20 questions from Quora. I keep a blog slash post on Quora.com, Quora. And about once a week, I get on there and do some questions. I get a bunch of questions, actually. And yeah, frankly, they say they're addressed to me. I don't know who they're addressed to, but this says it to me. So I hate to be so cocky to think, oh, everyone's looking for my opinion, my advice. But Quora probably gets a question. They see them in finance. They throw it to me. So I'm going to answer 20 questions here that we're going to talk about. And if you want to add your own, put them up in their chat box. I know it's a Monday at 10:13, so I'm sure you're busy at work, slaving away for the man. I'm telling you, man, being self-employed is the best thing that ever happened to me. There's a guy named Graham something who does YouTube channels. He goes, I'll never go back to the 9 to 5. And I tell you, I mean, if it's digging ditches or something like that, I will, I have to, but being self-employed is the most liberating thing you ever had. I'm just telling you right now, I will never be rich. Never have wanted to be rich. I'm comfortable with that. If you want to be rich, being self-employed, well, it's going to take some time. But if you want to be rich as a corporate exec, this won't be the way to go for you. But if you want to have independence and liberty, it's awesome. All right. So let's start into there. Question number one, what investment vehicle options are there besides an IRA, 401k, or Roth IRA, or Roth 401k? A good old-fashioned taxable account. I think a lot of people overvalue the tax deferral of an IRA, 401k, 403b, TSP, and they undervalue the tax benefits that are in a taxable, i.e. brokerage account. Now, I'm not talking about a bank CD. There are no tax benefits in there. I'm not talking about bonds in a taxable account. There are no taxable benefits there either because both interest payments from a bank or a bond come out as taxable as ordinary income. I literally just posted a video, just literally about a half an hour ago, an hour ago, called ETFs versus mutual funds when it comes to taxable efficiency. And the capital gain tax, my friends, is the most underutilized. Well, there's a couple of things. The capital gains and step up in basis, and both go into a taxable account. A non-qualified, a non-IRA, non-401k, the taxable benefits you get from mutual funds or ETFs, I should say, from capital gains, qualified dividends is just immense. It's essentially tax-free if you're a middle income taxpayer. You're tax-free with not tying up your money, no 10% penalty, nothing like that. I don't overlook the benefits of a non-taxable account. An ETF, a mutual fund has taxes, which I don't know if I can link to it here, but if you look at the video I just posted, the difference between mutual fund taxes and ETFs combined over time is just immense. Never mind the difference in a step up in basis where if you die, it transfers to your heirs, the surviving spouse, whatever, tax free. And I'm going to do another video on that here in just a second on what, I'll get into that here in just a second. But anyway, the difference in taxable efficiency on a non-IRA account, I'm using IRA all encompassing versus a taxable account is immense. Remember, if you have $100,000, if you're married filing jointly, and you have $100,000 of gross income, and you're under the age of 65, you have taxable income of $76,000. That means as long as you're in the 12% or 10% tax bracket, your capital gains are tax-free. Now, you can't just say, I have $76,000 of taxable income. I'm going to sell $200,000 of capital gain property where I have no basis. That's $200,000 for capital gain. That will put you above the threshold to be taxed at 15%. You can't just all of a sudden sell all your stock and because your income is only $76,000, you don't pay tax on that capital gain. It doesn't work like that. But at the end of the day, if you have, let's say, $45,000 of taxable income and you can sell $30,000 of a capital gain, you get nothing, my friends. There's no taxes due on that. And I just showed you on the 1040 in the video I just did, line item by line item by line item, which I want to go back to and show you this again, which is a capital gain and it's a qualified dividends and capital gain tax worksheet. It's amazing how many people overlook this. And I don't get it. I do get it because we've been told defer, defer, defer as long as you can. And I'm not saying don't do that. For heaven's sake, I got another question on here about 401ks, which we'll talk about. But don't overlook the power of a taxable account for you in terms of your overall financial well-being. Secondly, there's no penalties on it. The only penalty that you could pay is a tax. I mean, literally, if you sell a stock for 10 and you bought it at 5, you have a $5 capital gain. That might be taxed as long-term capital gain. As long as you held it for a year, you're going to pay 0, 15, or 20. And if you're falling a certain high level threshold, you pay on the net investment income tax as well, NIIT. So the max will be 23.8%. But if you're up that high threshold anyway, your tax bracket is well above 23.8 anyway. So no matter however you slice this, your capital gain will be less than your ordinary income tax. So don't overlook the value of a taxable account, a good old fashioned mutual fund. And I still prefer ETFs. You know, Vanguard now just who was it? Someone, Med Faber, I think, was telling how Vanguard offers commission-free ETFs. Schwab commission-free ETFs, so you can buy an ETF and not pay anything. I don't know if they have account maintenance fees. I have no idea, but man, can't beat that. So don't overlook that. Just along those lines. If you're going that route, don't have bonds. I mean, bonds are dumb. You don't want bonds in a taxable account if you're making an income because it comes out as ordinary income. Don't do that. You want it as tax efficient as possible, and bonds are the least tax efficient thing. All right, so this one's pretty easy. How can I calculate my total amount of money in 5 years if it's growing at a 5% per year rate? I mean, it's easy for me. It might not be easy for you or whoever wrote this. So you take your trusty calculator. We're going to say you have $10,000. And we're going to assume we're compounding. Compounding versus simple is different. And so let's just say compounding. We take $10,000, we times by 1.05, times by 1.05, times by 1.05, times by 1.05, times by 1.05. And in 10 years, or 5 years, we have $15,768. Going on, my man, Mark. All right, so that's how you do it. You say your interest rate you're going to receive. If it's compounding, you times your starting value at 1.0x your interest rate. In this case, is 5%. And the 1.05 times 1.05 times 1.05 is how you compound it. And that means your interest is building interest on itself. If it's just simple interest rate, it's even easier. You take your $10,000. We have 5% over 5 years. So we just take 10 times 1.25, and we got $12,500. I probably should throw it up right side up because it's not being compounded. The interest isn't building on the interest it made. So that's the difference between, and all you do there is you say, I got 5 years, I'm getting 5%. So I take 5 by 5. That's my 25% simple interest or non-compounding. So I times my account, my $10,000 by 1. That 1 is your times it by itself, 0.25. That's 25% above the amount you started with. That's how that works. So 1.25 times your initial starting point, in this case, is $10,000. And that gets confusing, but it's a big difference between simple and compounding. Simple is just interest times years. Compounding is interest times years, which is, again, 1.05. Why do people not put maximum contribution to the 401k? I frankly, this kind of goes along with part one, is because you should do your 401k up to your match. So if they match us a 5% and you got $100,000 income, they give you a 5% match, then you'd be crazy not to put 5% in. That way you get that $5,000 match. It's insane not to do that. Now, if you're desperate, well, obviously you can't do that. If you have a loan and you can't make that loan payment, it's going to be tough to do that, but it's free money, man. It's free money. So definitely take everyone. No one's going to deny that. I was just watching this guy's video, Grant Cardone or something like that, how 401k is a scam. What the hell is that? It's the weirdest thing I've ever seen. I was like, if I get $5,000 free, I want $5,000 free. There's no scam about that. I mean, it might be too expensive, whatever, but $5,000 is free money. I want that. So once you take advantage of the match, I'm not a big fan of the 401k because I believe you can be much more tax efficient and much more liquid in your money by having money outside of a 401k or outside of an IRA. Now, I do like the Roth. So it should go like this. Your 401k, take advantage of the max, then do a Roth, because Roth is beneficial relative to you always have access to your principal, regardless of how many years you've owned it, regardless if you're over 59.5 or not. So always do the Roth to the extent that you can. You might not be able to because there are some pretty significant income contribution limits, but most people can. So you do the 401k, the match, you do a Roth, subject to your income limits, and then you put in a taxable account. Absolutely. Now, some people say I need the tax write-off. Well, in that case, do the 401k more. Mark says is it better to stay in a retirement allowance plan or contribute 5 to 10% employer? You got to clarify that. I'm not sure what the retirement allowance plan is, Mark. Or contribute to a 5-10% employer match. Elaborate on that. What did you? I'm not sure. So anyway, take advantage of the match, Roth, then taxable account, if that makes sense. Or take advantage of the match, forget the Roth and taxable account if you think you need liquidity, because Roth does have some limits on how much liquidity you can get. You can only get the contributions you put in, and you can only limit it to 5,500, I think is what it is this year for contributions. So if you need a lot more liquidity than that, then a taxable account is the way to go for sure. All right, so I'll wait to see what you say there, Mark, about your questions. I'm not quite following that. What's the worst personal financial advice you ever received? Yeah, probably not to put anything down on a home. I don't know if that's the worst. Just that's what jumps out at me. We've been lucky. My wife and I have been lucky. We've always, anytime we price our house, we always price it to sell. But I just remember in 2008 when we were hurting, man, 6 mouths to feed and one income, and the income was dropping like a brick in water. We had to move to San Antonio, and if we couldn't have sold our house, we would have been in a world of hurt. Okay, so I'll answer that here in just a second. So, everyone say don't have any equity because you can make more in the market. And I frankly have never understood that in terms of, you could potentially on paper. There's no definitive amount there, but at the end of the day, what if you have to sell your house? If you have no equity in your home and you got to drop the price to the point where your mortgage is worth more than your fair market value is in terms of what you could get for your home, you can't sell your home, and then you can't move to San Antonio to take a better job. And thankfully that never happened to us, but man, it was close. It could have been. And I'm just telling you, I've seen people who got a better job opportunity. In fact, I talk about it in my book, right here, Strategic Money Planning, 8 Easy Ways to Get Your House in Order. If you can't sell your home because you can't drop the price enough because you have no equity, you're stuck. And that's just bad place to be. So the worst financial advice I've ever received was 100 in VA. You can use VA loan, 100% loan to value. You don't have to put anything down other than whatever the VA, I think it's like 2.5, I can't remember what it is, but the VA fee. In hindsight, I said, man, we got lucky, because I know people could not sell their house because they could not drop the price enough to make a sale because they had no equity. And no bank is going to let you walk out if you're upside down. You got to pay that sucker. So Mark says, all right, so again, it's a better stay in a retirement allowance plan, which is years of service, average salary, 10 years times 1/8 of 0.0125. I don't know what's better. If it's the employer match, I just take advantage of the employer match, Mark, up to the extent that they do. If it's a pension plan, defined benefit plans, years of service, it really shouldn't have anything to do with your contributions, frankly. It should, like if it's a military, you don't have to contribute anything. You just get a years of service. You get, I think it's 2% times each year of service, I think is what it is off the top of my head. And so it has nothing to do with your contributing. So again, if it's like a military and you don't get a match on the TSP, then the TSP might not be your most advantageous offering in terms of the TSP, unless you have income that you got to reduce. If you have a lot of income, you need to get it reduced because of taxes. That might well be. But as a defined benefit where they give you a salary based on number of years of service, that really has nothing to do with your contributions. It'd just be the 401k or 403b or the TSP or the 457 plan, and then just take advantage up to the max and then be done with it, in my opinion. Each personal situation dictates, my friends. Is having a 401k plan necessary for today's retirement plan, and what would be the return on investment for retirement? Okay, I should have looked at that. I don't know. Return on investment be worth it? Okay, that's the one I'm just going to scratch because I'm not following that. What common financial advice should you always ignore? This one gets me mad. So I was running I look as a tax forum for these wonderful folks on Saturday, and the issue was, should they pay off their mortgage or should they keep it? And one of the reasons to pay off their mortgage, not to pay off their mortgage, was they wanted to keep the interest because they could take the tax deduction. One of these days I'm gonna print off a 1040 and have it here. I wish I did. Yeah, it's a mess. Anyways, if you look at your 1040 and your itemized deductions are less than $24,000, if you're under the age of 65, you're not getting a tax write-off off your mortgage. You're just not. And that's in 2018. 2017 is different. But if you look at these folks, you can see that an itemized deduction is about $12,000. You add $6,000 of even that on mortgage interest, they're only having $18,000 of itemized deductions. Their standard deduction is $24,000. So taking a mortgage for the tax deduction, I literally want to take this anvil on my head and drop it on my head, because it's insanity if there's no tax deduction. I don't understand why people the accountants say you need the mortgage for a tax write-off. Well, if you don't have a tax write-off, then that blows up that argument. How do you know if you have a tax write-off? You look at your 1040. Just look at it. Look at Schedule A is itemized deductions. Do you have more than your standard deduction of itemization? If you don't, then that argument is just null and void. So in this case, we're comparing a 4% mortgage, and initially we're thinking we could write off 25% of that. So the guy, and rightly so, this is what I've been told. He said, I got, basically a 3% net return on my, that's what it cost me to borrow money, 3%, because you got 4% of my interest. You factor off 25% tax deduction, and I got a net cost of borrowing those funds of 3%. Well, you don't have a net cost of borrowing those funds at 3% because it's actually 4% because you're not writing off. So now we got to compare 4% relative to what you could get out in the market. In this case, he's pretty conservative, thinks 7%. And I said, that's, so he's not swinging for grand slams here, but I think that makes sense as well. If you can hang in there when the markets go like this, then you will be better off by keeping that mortgage and hanging in the markets, as long as the market returns you expect come to fruition. And I have every reason to think he's right. But that's different, a 4% versus 7% versus a 3% versus 7%. It changes the construct a little bit. And these guys are fine. So I don't have any qualm with them hanging in there when the market does like that, because they did it in 2008. Other people, on the other hand, I think it's horrific advice. And I hear it all the time. Get a mortgage for the tax deduction. And I just, that's bad financial advice. Did you or do you plan to start collecting Social Security at age 70 instead of my full retirement age? Why or why not? Yeah, I do plan on collecting at 70 as opposed to 67. I was born in 1970, so my FRA is 67. If you're born in 1959 or before, your FRA is 66 and some months. So just depending on your year of birth. I was born in 1970, so it's 67. Because I like the 8% guarantee rate of return, absolutely. And Social Security is so much more favorably taxed. And again, look at the thing I just did, the video I just posted on the tax rate that I show you, line item by line item, a 1040. The taxes that you don't pay with Social Security and long-term capital gains versus the taxes you will pay with taking required minimum distributions from IRAs. It's just a difference is night and day. So Social Security is much more tax favorable, which means it's better on long-term capital gains and qualified dividends. It's better on my tax bracket. It's better on my Medicare premiums. And it makes my other Social Security less taxable as well. And when I die, it's better for my surviving spouse too. So it's I don't have a quintile, a 5-bagger, all the beneficial ways Social Security is more favorable tax than taking it earlier. So if you can hang in there, definitely take your Social Security at 70 if you can. Now, if you can't, because there's another question on here in terms of, why would you take Social Security early? And the answer to that is because you have cash flow issues or you're not in good shape. If you have a history of sudden death in your family, your dad died at 62, your mom died at 65, Uncle Bob died at 59 because of heart, whatever. Well, shoot, take Social Security early. But if you're married now and you were the higher breadwinner, you don't want to do that, because then you're going to limit your surviving spouse's ability to take her survivor benefits. So you just got to be careful there. Got to be careful. Just because you are not in good shape, if your surviving spouse is, and your surviving spouse stayed home to raise a family and you were the breadwinner, if you take Social Security early, yes, you will get some money while you're alive, but then your surviving spouse will get that when you die. And if we think you're going to die before he or she most likely, then you could be putting her up against the wall. So we just got to be careful there. But that would be one good reason, or two, when it takes Social Security early. A, you're not in good shape. B, you need the money. There's no other way around that. And if you're single, it doesn't really matter. I mean, I guess you could say it would matter in the long run in terms of way down the road how much money you have to take out from an IRA or 401k. But if you're single, generally speaking, I have no problem with someone who takes it early. So this is a weird one. Can I take $400K out from my 401k retirement account? The max you can do is you can borrow $50,000 or 1/2 of whatever your vested value is, whichever is less. Yes, whichever is less. I always got to make sure I get that. So now that's if you're still working for that firm. That's the max you can do. You can't take more than $50,000 out, and you can't take more than 50% of your value, whatever your vested value is. So if you have $75,000, the max you could take out there is what, $37,500. That's it. So if you take out $200,000, it'd have to be as a distribution. Absolutely, you can do that as long as you're not working there. But then you're going to get hammered from the tax man. So I would not recommend that in the least. You could. Answer is yes. As long as you have access to take that big distribution out, you can do that. That scared me to death when you look at your taxes. Is a tax-deferred investment always preferable to a tax-exempt investment when it comes to retirement? So I'm going to think tax-exempt investments is being indicative of municipal bonds, and the answer is absolutely not. Is a tax, or I should say, is a tax. Well, it's not. Nothing's ever always preferable. So, is a tax-deferred investment, to say an annuity or a IRA, more beneficial than a municipal bond fund? Yeah, maybe. I mean, at the end of the day, just remember your tax-exempt interest is part of the calculation for determining how much of your Social Security is taxed and determining how much your Medicare premiums are subject to not taxation, but what they are. So if you have a significant amount of tax-exempt interest, that falls under your MAGI, and modified adjusted gross income is all your income plus your tax-exempt interest. That's what's used to calculate how much of your Social Security benefit is taxed and the premiums you pay for your Medicare, your Part B and Part D. So if you have, I just be advised, you got to be careful there. Tax-deferred interest, if it's an annuity, I'll even go back to a non-IRA, because annuity never has required distribution. So one of the benefit of an annuity or a life insurance contract is cash value. Because there's no RMDs, required minimum distributions, you literally never have to touch that money. Now, somebody's going to touch it, and somebody's going to have to pay tax on that money, but it doesn't necessarily have to be you because there's no required distribution. So in some ways, in that regard right there, if you're up against the top of the tax bracket to make your Social Security more subject to tax, or to make your Medicare premiums higher, you definitely want to be careful on your annuities versus tax exempt, or your IRAs versus IRAs, because there are RMDs. Your annuities, life insurance, or any kind of tax deferred vehicle as opposed to tax exempt. That could be a big deal, and I think a lot of people don't realize. The Trumpster says he is considering indexing capital gains to inflation. Is this a good idea? It's part of my French, but hell yeah, it is. A long time coming. Doesn't look like it's going to get through, unfortunately. And some of the financial planning group I'm part of, we don't know how to do this. It's going to be too complex. Oh my goodness, talk about confusion. I got a guy I'm working with from India, right in California. He tells them they do in India. So in India they can do it, and no one's run around with their hair on fire. They're doing it. It can be done. The idea you don't tax your capital, you don't index your capital gains for inflation, just it boggles the mind. And the idea, and this one guy wrote me back, says, we don't do that for income on bonds. The hell we don't. Yes, we do. It's called a tax bracket. And the tax brackets are inflated each and every year for inflation. So if you get $100,000 of income from a bond and you're in the 25% tax bracket, next year you get $100,000 income from a bond, but the tax bracket begins to creep up as inflation does. So your bond is paying $100,000 each year. Your taxable income goes up each year for inflation. So at some point, that $100,000 will no longer be in the 25% bracket. It'll be in the 15 or whatever. That's 24 and 12 today. So that's how it works. So your bond is flat. Your tax bracket goes up, it creeps up each and every year for index or inflation. So we can do it for bond income because of tax brackets. Why can't we do it for capital gains? I did a blog post on that, as a matter of fact. Maybe I'll post it if I can find it, on exactly why that should be done and exactly what kind of ramifications there are from not doing it. And again, it's not the rich people who suffer, my friends. It's the middle class people, like they always do. The rich people got the lobbyists to lobby for them. And going back to, how the 401k even came to be is because Kodak Company, and that guy Graham, I just learned this. I didn't know that, actually. I can't remember his last name, Graham. I like him, actually. Big real estate guy. And I'm not a huge real estate guy, but whatever. And I didn't know that. But he said that it's from a tax law that Kodak lobbied for Congress in 1978 or something like that. And presumably it's true. I don't have any reason not to believe this guy. But that's the power of the lobbying groups that these guys have. Who has a lobbying group for old Josh? Nobody. There's no lobbying group for old Josh and my man Mark from Philly there. And so the rich people have the power of the lobbying groups to make sure that the tax code is more beneficial to them. And we're left holding the wet bag. And so if just Grandma Jones had bought a stock of, I don't know, whatever, Apple in 1998 when it was at 7, and now Apple's at whatever the heck it is, and she sells that, she's paying capital gain tax on the basis of 7%. I mean, it's $7 a share. Not index or inflation. And, that's 30 years, 20 years ago. So 7% at 3% inflation, I have no idea what that is. $7 as their cost basis at 3% inflation. That would save her a boatload of capital gain tax. It's sickens me. And then to have all these professional financial planners, it's too complex. Have you seen the friggin' Medicare stuff? My goodness. No one talks about the complexity of the Medicare. Never mind Social Security. Social Security is easy compared to Medicare. Never mind the tax code. But it's too complex. It's crazy talk. Yeah, you can tell I get very fired up. The idea that complexity should keep us from doing something right. Then on top of that, you have the country of India, which, by the way, happens to have a whole lot more people than the United States does. They already have it in place. So why can't we do it? Crazy. All right. So what are some of the benefits of a living trust? This one's a big one, actually. I think though some of the benefits get overplayed, i.e. avoidance of probate. So the benefit is avoidance of probate. That's a fact. Anything that's in the trust avoids probate because your probating is a public proving of the will. Hey, my man Dave. Dave's the guy who did my website. My website is up to date right now. It's awesome. And my man Dave Simon there, I forgot his website. I'll have to put a link. But if you're looking for a guy to do your stuff, he's a good guy. I love him. He came to me through my YouTube channel, and it's cool. He redid my website. And Dave, if you remember if you want to put your web address on there, put it on there so folks can see you. Highly endorse him. Easy. Every time I have a question, just pick up this sucker, and he's just like that. Good guy. Anyway, so what was I saying? Oh, the benefits of living trust. All right, so living trust. It avoids probate because what is probate? Anybody? What is probate? Probate is a public proving of your will. Notice I didn't say a public proving of your living trust because a living trust does not go through probate. So inherently, it's not a public proving of it. So probate is a public proving of your will. So a living trust, because it is not a will, doesn't go through probate, which means everything is private, which is good. Now, if you're only trying to avoid probate, it's easy to do that stuff. You don't need a living trust to do that. The only way to do that is through your home, a piece of real estate. So a piece of real estate, if you're trying to avoid probate, then a living trust would be beneficial. Probate, in terms of probating a piece of property here in Fulton County, Georgia, it's not going to make or break it. It's your executor or executive. It's just not that big of a deal. I heard in California it's a nightmare. I don't know, but that's just what I hear. So one of the benefits is to avoid probate, but there are easier ways to avoid probate than getting a living trust. Secondly, it's private. It is private. So going back to the Aretha Franklin example, I mean, the facts are we all know what Aretha Franklin's estate is and whom she left her assets to. And given that Aretha Franklin was a very private person, that's probably not what she wanted to happen because will is a public probate is a public proving of your will. Now, Aretha Franklin didn't even have a will, which inherently means it's intestate, which inherently means it has to go through probate. And all the people, they're smelling that bread out there. They're all going after like white on rice to get their piece of the pie, even if they never even met Aretha Franklin. So that's a benefit. The best benefit is I'm dealing with somebody who's got a special need. I forgot who it was. I deal with this all the time. They got a child who's got special needs. The child can't take care of himself. Someone has got to take care of the child when this guy and his wife die. And so a trust, the major benefit that I see, frankly, is that you can name a trustee to take care of that kid or that adult at that point, and that person will be tasked to follow the rules of your trust. And you name a trustee, being a Bob down the street or the corporate bank or something, whatever you want to do. You name a trustee to make sure that the kid is taken care of financially, and then you can name other ways to make sure the kid is taken care of emotionally, whatnot as well. That's a big deal. I do think if you have a kid with special needs, or if you have a kid that you want to make sure doesn't take the $200,000, you leave them and sniffs it up their nose, you got to protect him from himself. A trust is very, very beneficial there. The critical thing there, though, is the trustee. Who is the trustee? And this gets overlooked a lot. The trustee is the person who now is in charge of the property. And if you're thinking about becoming a trustee, I highly advise you to be careful. You are now subject to the estate to be distributed and benefited of the beneficiaries. And if you screw that up, not even if you did it, but they think you screwed up, you're going to be subject to a lawsuit like you wouldn't believe. A huge cottage industry of suing trustees all over the place because they're not making sure the trust document is adhered to a T, or the beneficiary of the trust is up in arms because they didn't think they got enough money from grandma's trust and they're really upset and they're going to sue. I'm telling you, be careful. Being a trustee, especially for family dollars, I'm not saying don't do it. I'm just be careful because you are responsible to the beneficiary. The beneficiary absolutely is who you are responsible to. And if you screw that up, I'll give you an example. Say I have life insurance in that trust. It's called an ILIT, an irrevocable life insurance trust, and you're the trustee. and you let that life insurance policy lapse, and the beneficiary over here thought they were going to get $300,000 of life insurance benefit tax-free. Hate to be you, because you let that puppy lapse because you're the life and you're the trustee, and you're taking a fee off that trust of 1% a year, whatever it is, and you weren't keeping up to snuff on that life insurance being in force. Yeah, good luck with that. You're going to lose, and you should lose, because that was, you screwed up. No other way around that. Got to be careful. Got to be careful. So lots of benefits of the living trust. I think they get overplayed a lot. If you have real estate in multiple jurisdictions, again, I talked about this. I live in Fulton County. Let's say I have a beach home in, Orange Beach, Alabama. I got a mountain property in Gatlinburg or something like that. I don't want my heirs to have to go to Alabama, Tennessee, and Fulton County to probate all those assets. So I want to have a trust as a all-encompassing part of the, so that way probate can be avoided. Because again, probate is a public proving of the will. I don't want my kids to have to go all those different places to probate the real estate. So I'll go ahead and get all those pieces of real estate in my trust while I'm alive. So that way at my death or my incapacity, my trustee can step up. A lot going on there. Lastly, I just say, for incapacity, a trust is wonderful. I mean, the facts are, if I have Alzheimer's and I don't know who I am, my wife's dead, my trustee now can, hey, what's going on, Cindy B? Cindy B. My trustee can come in and take care of my situation. If I have Alzheimer's, I don't know who I am. You can't really do that so much in a non-trust document. I talk about a durable power of attorney. It just, durable power of attorney is the starting point without question. But for some capacity, a trust is even going to be that much more beneficial, because it's going to be more in there in terms of, you should see some trusts that you see. I mean, they're talking, that big, because all these different things are stated explicitly of what can and cannot be done by the trustee. So long-winded answer to a living trust. Again, always get this book. And I was looking for it this morning. I don't know where I have it. Beyond the Grave by Condon, Gerald, C-O-N-D-O-N, Beyond the Grave. I don't know if I can type that in. Let me see if I can. I'm going to type Beyond the Grave, Gerald Condon. And he's sweet, it worked. So that's the book you should get. Absolutely. I think it's like $15 for the paperback and $8 for a Kindle. I tell you, you read that book and it's going to open your eyes without question. Wonderful book. He and his dad were a state. I've never met these guys, but it's the best book I've ever read by far. All right. So do I have to pay capital gains if I transfer my brokerage account earnings to an IRA? Yep. If you get earnings, you go live each week, or no, I just kind of do when I Cindy asked, do I go live each week? I've been thinking about doing that like on a regular basis. If that would be helpful, let me know for sure. And if you have a time specifically, I real quick, I love doing this. I can't lie. I'm addicted to it. It's fun. My wife says, you're doing a video, and it's cool. She's cool with it. She knows I enjoy it. And the fact that I have some advertisers on now, YouTube pays me a little bit. I'm not going to get rich off it, but it's cool. So if you want to help me out, just watch those ads. It'd be wonderful. I've been thinking about doing, I have no clue who ads, by the way, no idea. I think it's Personal Capital. They do a lot of ad. I actually pay for the premium YouTube, by the way, so I get to skip all the ads when I'm watching other people's stuff, which is pretty sweet. It's like $12 a month. But I'm interested, if that's what you all would like a regular thing, I don't know, whatever it would be, let me know. I'm self-employed. I can do whatever I want. So I'd be interested to see what you say. So Cindy, if that'd be something preferable, let me know. What was I saying? Oh, do I have to pay capital gains transfer? Okay, so do I have to pay capital gains if I transfer my brokerage account earnings to an IRA? Anytime you have capital gains in a brokerage account, you're paying tax. It doesn't matter what you do with it, but you're going to pay tax. So you get a $100,000 brokerage account, of which has a $5,000 capital gain. I don't care if you freaking light that money to light a cigar. You're paying tax on that capital gain. That is a fact. The only way you're not paying tax on the capital gain, the only way you're not paying tax on that capital gain is if you have capital loss carry forwards. Man, I'm going to print off a 1040 so I can show it to you. One of these days I'll do that. I'm going to do that when we get off. Capital loss carry forwards on Schedule D. I can't remember what line item it is, but Schedule D of your 1040 will show you if you have capital loss carry forwards. I don't remember the line item, but anyway, it'll say right there, I got $65,000 of capital loss carry forward. So if I have $65,000 of capital loss carry forwards and I have a $5,000 capital gain this year, my capital gain is nothing. Has nothing to do with what I do with the proceeds. Nothing. In fact, to answer this person's question, if you reinvest those capital gains in your brokerage account, you're still paying tax. That's just a fact. You will pay tax on your capital gains, bar none. End of story. Now, There is sometimes you don't pay tax, but it has nothing to do with the capital gains. It has to do with your tax bracket. So watch my video I just posted. Literally, I show you line item by line item the ETFs versus mutual funds, where I have an ETF with a 0 turnover, means there's no capital gain distributions, and I have a mutual fund with a 5% turnover. Watch the difference. I show you the whole thing, line item by line item. You will see people who've got nearly $150,000 of earnings, of gross income, money they can spend, and they're only paying $1,000, $2,000 in taxes. The reason for that is because of where their income comes from. I'm just telling you, watch. Now, on the other hand, you'll see people who have a whole lot less tax, who are a whole lot less income, who are paying $20,000 of tax. That is part and parcel the widow's tax trap. I'm telling you, it's freaking sickening to see. And I show you that in that video I just showed you. One on line is Bob and Jane YouTube, our best friends. And Jane gets hammered from the tax man because she's a widow. Drives me up the wall. Reasonable rate of return for 1 year in retirement. If I'm going to a stock portfolio, I think you can get 2% a year in dividends and 5.5% a year in earnings growth year over year. That's 7.5. That even might be on the high end. So if you 7.5%, you subtract out 3% inflation mark. That's about a 4.5%. Yeah, about a 4.5% real return. I think it's about spot on. Vanguard thinks it's probably between 3 and 5. Jeremy Siegel from Wharton, I think he's thinking about 5% real return. So I'm right smack. Look, they're smarter than I am. I'm just a dude. But they're, you know, if I can split the difference between Vanguard, i.e. Bogle, and Siegel from Wharton, I'm pretty good company there. So 7.5% nominal, 4.5 to 5% gross or net. That's probably what you're looking at, man. And that's for being in stocks. If you're in bonds, there is no return because your bonds are paying. Let's take a look here at the 10-year Treasury right now. Excuse me, 10-year Treasury is at 2.93. That's a 2.93. That's a 10-year Treasury. So that, let's just round it up and say 3%. You got to pay tax on that puppy, and you're losing out to inflation of 3%. There's no way you're going to make money in bonds. It just ain't happening. Pardon my French, but you're not getting any money in bonds. So a real return for bonds is probably less than 0. A real return for stocks is probably between 4 and 5. It's not pretty. It's not pretty, but that's what we got to look at. Reality is that's the reality that we're looking at today, unfortunately. How should I start with saving for retirement if I'm on my 30s or 40s? I just think an index fund or ETF is the way to go. I love VTSMX. I mean, I'll tell you that to anybody who's until I'm blue in the face. Start with VTSMX. Somebody on this podcast or whatever YouTube thing told me, I think it's VTI. So Victor Tango India, I think is the ETF for the Vanguard Total Stock Index, VTI. If someone knows, by all means, ask, throw out, tell me I'm missing it. But I think it's VTI for the ETF of the Vanguard Total Stock Index, but I don't know. So anyway, either way, you put $100 a month, $200 a month, whatever you can afford, just put that money in there and just keep doing it as much as you possibly can. That's how you do it. So if you're in your 30s or 40s, and you need to start saving for retirement, don't start freaking out. I never have enough money. I'm telling you, because what's going to happen is you'll start with $100 a month, then you'll break to 1,000, and it's a good feeling, man. And then you're going to break to 5,000, and then pretty soon, a couple of years, I'm starting to sweat because I got these lights on me. Then you're going to break to 10,000, and it's an addiction. It's like any other thing. You do what feels good. All right. So if it feels good to see that account growing, A, you're not going to sell it. B, you're going to keep adding to it. C, you're going to find ways to add more to it. It's a wonderful, wonderful feeling. I'm telling you, it's an addiction. It's a habit. And I got a book back there of habits. I forgot the guy's name. Anyway, some dude, I think I can't remember. He wrote The Power of the Habit. A wonderful study that I always refer back to that changed my life was Aaron Helmsley, who did the sales maximization. Helmsley and Associates. He's a psychologist back in 1982, and it just fundamentally changed me because it's all about the habit. If you can change your habit, your thought process to do what you enjoy, to avoid the things you don't enjoy, you're going to be happier and you'll be more successful. Whatever success is, not necessarily financial, but you'll be happier because you're doing things you like to do, i.e., I love doing YouTube. I hate with a passion paperwork. I hate it, but I love YouTube. So I'm trying to do as less paperwork, which is why I don't manage money, because managing money is just paperwork. I can't stand it, but I do like doing this. So anyway, once you start seeing your account growing a little by little, you'll get addicted to it. You're like, oh man, this is cool. I got $10,000. It's awesome. It is awesome. So just start. What's that proverb in China? The journey of 10,000 miles starts with a step. Man, it's a wonderful thing. All right. So a couple questions here. Unfair question from Mark J. Could there be a tax savings for a retired husband to file separately when doing a traditional IRA? Yeah. There's a guy, Money and Tax, and I interviewed him for my blog. I'm drawing a blank on his name off the top of my head. He's Mike the CPA, Money and Finance, or shoot. Anyway, I've interviewed him for my blog, for my podcast about a month and a half ago. And he was mentioning one of his YouTube channels about videos of the one time I think it makes sense to married filing separately. And I think that was with the new tax law, the 199A rules, Mark J. I've never, and I do not do professional taxes, so just keep that in mind. I've never seen the benefit of married filing separately, never. That doesn't mean it's not one. I think Mike the CPA was saying when you do it, if you're having a 199A for the new tax law for being self-employed, there is some benefits there. But I have to defer to Mike. And he's a good guy. I like his YouTube channel. A little bit different than me. He's an accountant, so he's got green eye shade, but he actually has a personality, so I'm a fan of him. Gray says, if you don't have cash flow issues withdrawing from 401k all the way to 70, but if death happens, your heir won't inherit the Social Security, but 401k fund is less. So what's the balance here? I don't know the balance, Miss Grace, but at the end of the day, that is true. I mean, if you take Social Security early or late and you're withdrawn from your 401k to pay for your expenditures, and then you get hit by the proverbial bus, you're going to have less to give back. I mean, there's just no other way around that because you're taking 401k assets out, which are being consumed, and you're allowing your Social Security to go just not tapping into it. So that would be an issue without question. However, but you don't say if you're married, and I'm not saying for you specifically, but don't forget if you're married, all right, you got to look at your surviving spouse. So giving you my example, my wife stays home to raise the kids. She doesn't earn an income, but she works a hell of a lot harder than I do. If I die, having taken money out of early from Social Security, she will inherit my 401k unencumbered. That's a fact, but she's going to pay tax on that. The tax is going to wallop her, and then she'll get a reduced survivor benefit from my Social Security. So she's getting reduced guaranteed income from Social Security, reduced the tax preferential treatment of Social Security, and she's getting more from my 401k, but more of that is going to the tax man. In my 401k, the distributions will also affect, like I said a million times a Sunday, her qualified dividends and long-term capital gain tax rate, her tax bracket, her Social Security taxes that she has to pay, her Medicare premiums as well. And again, just look at the video I just did. You can see how bad that could be for a surviving spouse. Now, if you're single and you want to leave it to your kids, yeah, that's a different story. Or your heirs, your nephew or something like that, that's a different story for sure. All right. So this one I like. Should you continue your education if you already got the job you want to retire from? Crazy. Yes, absolutely. I subscribe to a bunch of magazines and stuff. This is the Energy Advocate. I get this guy's newsletter out of Pueblo, West Colorado. I forgot his name. I'm a big fan on looking about energy, alternative energy, not the way that, I need PV photovoltaic panels in every house and all that. I actually like the physics behind it. I'm very interested in alternative source of energy, not because I think, I mean, this is going to be my personal opinion. Nothing. Well, it does have to do something with finance. If you think you're going to fly all over the world and be green, you're wrong. You're the amount of CO2 you're putting in the air from shipping goods overseas and flying over the world is going to dwarf anything else you could do over the course of a year. And so one of the reasons I do like the studying alternative electricity and alternative energy in particularly is because I do believe in self-sufficiency. And if you have photovoltaic panels on your home and your rooftop, that's wonderful. I got no problem with that. But if you're using that as a way to be green and then you're flying all over the place, they're mutually exclusive. And so I'm very interested in green technology because I think it's a wonderful thing for bringing things local. I do believe in local gardening, local community building, buying product off your neighbor as opposed to having it shipped from Thailand or something like that. I think being more of a local centric community, I think is what America is actually missing quite a bit now. So I get Popular Mechanics. As you can see, that's well read. I get all kinds of stuff from an education perspective. I'll probably go take a course up with Gwinnett Community. I forgot it was a technical college. I've drawn a blank. I've been wanting to do this for a while. Yeah, I think it's Gwinnett Technical College. I want to take this course on some kind of it was engineering. I can't remember. But anyway, I wanted to take a course because I love the idea of continuing to learn in my education. Education is not schooling. Education is learning on your own YouTube channels. A lady, Miss Sue, who is creating this wonderful spreadsheet, which I think I'm going to get out there here today. She does a lot of watches YouTube videos on woodworking, and she's learning a lot. And I think it's fantastic. Rocket stoves, for instance. You know what a rocket stove is? I never knew what a rocket stove is. I came across some guy on YouTube. He's building a rocket stove with just cement. I said, man, I can do that. And next thing you know, I'm building rocket stoves. It's cool. Anyway, so keep your education regardless of a job that you like. And I will tell you real quick, you can go to MIT and study anything you want at MIT online for free. It's insane. And George Mason, where I went to college, they have the Marginal Revolution University. If you want to learn about economics and Austrian economic theory, free market stuff, all that stuff's for free. You can literally go to MIT to get a degree for free. I don't know if you can actually get a degree, but it's insane what's out there. All right, so let's see. Elizabeth says, is it better to leave Roth IRA money? So Elizabeth is what's it called? Stringer. Is it better to leave Roth IRA money or traditional IRA to my kids? 100 times out of 100 is better to leave Roth IRA money. Read my book, Elizabeth. You can get it free on Kindle Unlimited. In fact, my man Dave Simon just already wrote about it. I said about that today that he's talking about it. So anyway, yeah. Remember, traditional IRA has required minimum distributions, and a Roth does too. I will tell you that for non-spouse beneficiary. They are going to pay tax. They're going to pay tax on your traditional IRA at their tax bracket. If you leave it to their kids, and the kids are radiologists, and she's making 500 bones a year, and she gets a $10,000 required distribution from your IRA, she's losing 35% of that, never mind whatever Cuomo charges in New York or Nathan Deal charges here in Georgia. You do not at all ever want to leave a traditional IRA if you can avoid it. You just don't. It's horrific, horrific. Cindy said, I'd also like a rocket stove. Oh, man, I love them. Battery1234.com. My man Steve Harris at battery1234.com. Oh, you'll learn everything about rocket stoves, how to power your house from your car battery. Oh, it's awesome. $35 and you get like 10 hours of video. It's just fantastic. Let's see. Which elements of the current tax system work best and why? I love the step up and basis rules. And I just going back to what Miss hey, thanks, Cindy. Cindy says I love both my books, and I didn't pay her to say that. Let's see. This goes back to what Elizabeth asked. What's my favorite element of the tax code? It's a step up and basis rules. All right, so you got it. I have $100,000. I bought a Vanguard ETF VTI. I die when it's worth $500,000. I leave it to my spouse because it's not jointly owned. It's just owned in my individual account. My spouse inherits $500,000. And it could be Cindy. It doesn't matter. It could be anybody, a human being. If they inherit that $500,000. I had $100,000 my basis, $500,000 of date of death valuation. That $400,000 transfers to person tax-free. That's a step up in basis. That is amazing. Now, why you want an ETF? Because all the while that's building that $400,000 of tax-free distribution of growing, there is no capital gain distributions. It's all unencumbered growth, which means at your death, it will transfer to your whoever it is. It could be me. By all means, leave it to me. Just joking. But anyway, it could transfer tax-free. Not only could it, it will because of the step up and basis rule. So everyone focuses on the IRA. I'm like, look, focus on the IRA to the extent that you need the tax deduction, need the tax deferral, or you need to get, well, that's pretty much it, a tax deduction, tax referral. But don't kill yourself trying to funnel everything to an IRA. The Roth is the best thing, bar none, but the IRA is last in terms of the overall wealth you can create for you and your surviving spouse and your multi-generational wealth building. The Roth IRA and the step up and basis rules on a non-Roth IRA, a taxable account, are wonderful, which goes back to the thing, no bonds for the love of Mary, no bonds in a taxable account. A taxable account, we want to get as much growth as possible. So we don't want any dividends. We don't want any capital gains if we can avoid it. We want that puppy to grow like our rocket stove that Cindy B and I both love. Get that puppy to grow as much as you can. At death, it transfers to your heirs tax-free. Your Roth transfers to your heirs tax-free, and hopefully there's a minimal traditional IRA or 401k that your heirs will have to pay tax on. Just two more here. The primary difference between a 401k or a 403b. This is a pretty good one. We used to call, I don't know if they still do anymore, 403bs as a teachers and preachers accounts. All right. So it used to be for nonprofits, teachers at the school district. I guess, universities, preachers, anyone working nonprofit essentially could get a 403B. The 403B has always been an area that had high fees, lots of annuities. Never understood why that was such I'll give an example. This is a long time ago. My boss back in 2004 or 5 tried to get into the 403B market with a local school district, and he broke into it. And he was offering some services to some of the teachers there because they had nothing but crap in their school district. It was literally the highest commission, highest fee, crappy stuff you could possibly imagine. These are teachers, all right? These aren't rich people. They're just regular teachers. And he said, I can do better than this. And he got in there and he got badgered. He got a call from the lady who was like, had that market to herself, saying she was going to sue him. It was crazy. And I said, how could this possibly be legal that she owns the market on this with this crappy stuff? And he got out. He said, I can't afford to get sued by that. I don't know if that's right or wrong, but she was on him, like you said, a cease and desist letter, the whole thing. That has never happened in the 401k. I mean, maybe it has happened, but it's never happened in the 401k where one person can corner the whole county school district. It's insane. So 403B is notorious for high fee, high commission, crappy products, annuities, generally speaking. In fact, there's a company, I'm not saying they're bad or good, I forgot Valid, something life insurance company. I forgot what the VA stands for. Anyway, something life insurance company. And look, I got no problem with those guys. But generally speaking, they're life insurance, which means they're going to have annuities. That's life insurance, and annuities go hand in hand. So anytime you hear the word life insurance, that means annuities are part of the product line. And so Valak used to own these 403B markets like you wouldn't believe. I'm not saying that was the people who did that in that county. I don't know. I frankly can't remember. It's almost 15 years ago. But at the end of the day, I remember the 403B market could be very, very guarded like a monopoly for one advisor, and that one advisor is crazy. So that's the difference between a 403B and a 401k. Everything else in terms of tax deferral, required minimum distributions, all that stuff is the same. I don't know, frankly, if 403B market has been able to get a little bit more competitive. I just don't know. Until it is, I'll take advantage of the match, and then I'm not putting another dollar in there. That'd be my recommendation. I just don't know. Which is better investment choices would be number 20, unless someone asks something. Vanguard or Schwab. I worked at both. So just be advised. I worked at both. I worked at Vanguard in 98, 99, and Schwab in 2000. Yeah. And I like both of them. I do. I like Vanguard better. I think Schwab, is just a cut above in terms of what they offer. Technology. They have branches. Vanguard does not. But all this stuff costs money. I mean, there's no other way around it. Schwab is a publicly traded company. When I was there, there's a guy named David Pottruck, and he used to be big on getting this back in the 99, 2000. And they kind of ran him out of Dodge because he was trying so hard to make everything internet-based. And everyone's trying to do that back then. And it's funny, they went 180 degrees from that now, where they have branches all over the place. I'm fond of that. Frankly, I like Vanguard better because Vanguard is not a publicly traded company. They don't have shareholders to appeal to. They are owned by the investors. Like USAA is not quite, but basically a mutual company is owned by, it's insured, and that would be people with property casualty and whatnot. I just like that. I like that better. I like that market better. I like credit unions better than banks. I think credit unions are actually getting into areas they should not be, frankly, because their task was never to have business accounts. Their task was initially to take the unbanked, the Mennonite community, for instance, who did a different kind of banking than a traditional banker be, and they've really expanded on that. And I'm not a fan of that because I think it's subsidizing competition for the bankers, especially the community banks. I think community banks serve a lot of good for local communities, and I think the credit unions are poaching on that with the benefit of the tax code. I'm not fond of that at all. But Vanguard is not owned by shareholders. It's owned by its investors. Vanguard, look, at the end of the day, Vanguard is not as pure as wind-driven snow. Just be advised. I mean, everyone, I love Jack Bogle. My man Med Faber says, he's a national treasure. He's the founder of Vanguard. I think again, if we ever give a Nobel Prize in financial planning or finance, it should be him, bar none, without question. Then Rob Arnott, I love too, as I told about in a recent video. But I just like Vanguard. Charles Schwab, the story is he had a discount brokerage firm, and he changed the world. He did too. by offering low fee commissions when you could just a regular Joe can buy an investment because the commissions are so high. Schwab, again, just a national treasure without question. Schwab sold his firm publicly. All right. And so they started putting in Sears back in the like early 80s, mid 80s. You could go to Sears and buy socks and stocks. That was the thing for Schwab back then. And they've had a bunch of iterations since then of what they're trying to do. And all that stuff is fine. But when you're publicly traded, you got to keep on the ball with what your shareholders want. And Vanguard, to the extent that they don't have to do that because they don't have publicly traded stockholders, but they do have, investment managers and people who manage a lot of money who use Vanguard, who have a lot of say in how the companies run, which is why Vanguard brought out ETFs. Bogle didn't want to do that, but they realized that's a huge market that they were going to leave on the table if they didn't get in the game, and they did. You can't blame them. But at the end of the day, my preference is Vanguard. You can't go wrong with Schwab. I'm a big fan of Schwab. Absolutely. It's tough to go wrong with either of those two guys. But that's all I have for my 20 questions. Like I said, I'll probably do this once a week. I don't have any specific time. I'll try that for a month and just say what kind of time I should do. Here's so yeah, fire away questions if you want. Mark says, we'll be moving about a month and we'll have no debt as a result of a lot of cash flow. Any advice on where to invest the cash flow? All comes down to liquidity, man. Mark, if you need having no debt, freaking kudos to you, brother. I wish I was there. That's a wonderful, wonderful place to be. It's all about cash flow. If you don't need, so my rule of thumb is you have 2 to 3 years of cash. So if you need $50,000 a year, we're going to say you have no income, no Social Security, no pension, no nothing. You need $50,000 a year of income. So 3 years of $50,000. You put that puppy. So you got $50,000 in cash, $50,000 in 1 year CD, $50,000 in 2 year CD. You got 3 years of income covered right there, bar none. And then you put the rest in a mix of diversified mutual or ETFs, equity ETFs primarily. And then ideally what happens is you spend that first $50,000 down. The market has either gone up or has gone down. If it's gone up, you take $50,000 out to replenish it. You redo the CDs like that. If the market has gone down, you don't take the $50,000 out to replenish it. You just draw on these CDs. And ideally 3 years when you have no money in those CDs anymore and all you have is the market's come back to where, they've fallen, now it's come back. And historically, that's proven the case. Not all the time, but more often, the vast majority of time. So market's here, it drops, you don't touch it. Market's up here, it goes up, you touch it, take out some gains to replenish your cash. The market goes down, you leave it alone. You still have those CDs to replenish your cash. 3 years later, market's back up here, take it back out and replenish your cash. It could not be simpler. Is there a more efficient way? I don't know what it is, frankly. I'm sure that somebody has some algorithm, but keep it simple, stupid. And we don't need complexity. Complexity is the enemy of financial planning success. That's just all there is to it. If it's too complex, you're not going to do it. You're just not. There's just no getting around that. So I like 3 years of cash sitting 1 year money market, savings account, the bank, 2 year CDs, 1 year CD, 2 year CD, and everything else in equities. If the equities go up, cash, take some gains off the table, replenish your cash. Equities go down, don't touch it. It's just literally that simple. But the fact you have no debt, man, dude, it's way to go. Love it, man. Hey, thanks, Grace. Grace said she learned a lot. Appreciate that. Absolutely. As always, comments. Oh, yeah. So let me just real quick. First of all, for you guys who just, my man Dave Simon here redid my website. It's freaking, I love it. It's awesome. So heritagewealthplanning.com. We got a page on there for tax resources, I think is what it says. If you scroll down, you can see all kinds of tax calculators. We just use the smartasset.com has state-by-state analysis of your income tax and property tax. It's just freaking, it's awesome. And I just put that on there and they let me. And then the other one was from the Tax Foundation. Yeah, using the TCJA, the Tax Cut and Jobs Act of 2017. So you can go in there and just plug some numbers. It's like the best thing ever. It's all free. It's just right there on my website. You by all means go to smartasset.com. Be careful. I found smartasset.com and Personal Capital. If you go to these places and you start inputting a lot of info, they might give you a sales call. So just be careful there. Look, that's just what I've heard. I have not lived that myself, but just be careful. You can just use it on my website too. Just be careful before you give a lot of information about the holdings that you have. We don't need a bunch of people calling you for sales. And then I got the Tax Foundation. They'll never call you. They're a nonprofit. But that's a wonderful resource as well. Anyway, and then we're going to have, we got, anyways, I'm trying to think what else we had on there, Dave. But it's a new look, contact information. I keep all the podcasts. I keep all these videos out there. I keep my blog posts. Oh, that's what I was going to start saying. He made it so I can actually put in a couple, just a couple sentence posts. I don't use Twitter. I think Twitter is a cesspool, but that's just me. So I'm going to use it, every now and again, just updated what I see out there. I'm a big fan of the tax stuff. So anything tax wise, I'll post out there. For instance, in Kentucky, they just changed their tax rules, man. In April 2018, a big tax revision that you need to know about for sure. So if you're going to retire in Kentucky or live in Kentucky, that's probably what you need to know about. So I'll probably, when I see something, post something, here's an article you need to look at if you're a resident of Kentucky or something like that. So check frequently for sure, because I definitely plan on keeping a lot more going on there. So my man Daryl Staten says, love your videos. Thanks, man. Appreciate it, Daryl. That's good stuff. Makes me I love that you love it. I love doing it. I'm telling you, man, it's an addiction. Personal Cap will call you, says Daryl. They want to move all your money to stocks. Good resource to plan. I just ignore the calls now. Yep, that's what I've heard. So just be careful. All right, my friends, we're up against an hour, so I'll let you get back to the office. Remember, being retired or being self-employed is liberating. So if you're thinking about it, man, just make the leap, and I think you'll be happy for it. See you guys. Thanks.